여러분 안녕하세요. 저는 지금 제 옆에 어떤 분이 계시냐면 이안 린젠이라고 BMO 캐피탈의 채권 전략 애널리스트이신데 이분이 미국 채권 시장에서 넘버원입니다. 어렵게 이 라스베가스에서 만나가지고 한번 인터뷰를 하도록 하겠습니다. Ian.
Nice to see you.
Yeah, I'm happy to see you here in Las Vegas.
Yeah, it's great weather. Always a pleasure to see you.
Okay, first please say hello to my channel viewers.
Hello, channel viewers. Thanks for tuning in and hope you find this episode useful.
And Suribo, could you introduce yourself?
Yes. Yes, my name is Ian Lyngen. I work for BMO Capital. I'm a rate strategist, and I'm here today to talk about the market and hopefully provide a little bit of insight to the viewers.
Yeah. Okay, my first question is, actually you are responsible for the US rate strategy. So, nowadays there are concerns or there are debating about the Fed fund policy rate. So someone said the rate high cycle is over, or someone said just it's a kind of pause. So what is your view?
So my view is that the rate cycle is most likely over. We have reached Fed funds up to, or brought Fed funds up to 240, and even if there is another rate hike this cycle, it will probably do very little to the market, particularly the level of 10 and 30-year yields. And more importantly, given how much the Fed has already tightened, that incremental last 25 basis points really doesn't matter as much to the Fed as one might think it would. So from my perspective, I think they're either done at 240 or maybe they get to 260. I don't think that they're going to get to 3.5. If anything, the cycle has already started to turn, and I think the biggest risk is in the medium term, the Fed is forced to cut rates.
So you think the risk is maybe cut the rate?
In 2020, yes. Probably not in 2019, unless things deteriorate very dramatically on the economic scene domestically. For now, the pause has largely been a function of risk assets selling off. We saw that in the equity market, but we've also seen that in credit and different assets. I would suspect that once it's clear that the weakness has flown through to the real economy, then the Fed will be a lot more likely to cut rates.
But nowadays the stock market shows a strong rally, and because maybe I think early this year the Jerome Powell, chairman of FRB, has changed his monetary policy stance from hawkish to dovish or not neutral. So I think that change of the monetary policy could give the positive impact to the stock market. So if current stock market rally continue, in that case, Fed could change their monetary stance again to hawkish.
Well, if the rally in the stock market is based on an easy Fed, which it is, I agree with that, and the Fed chooses to no longer be easy, then one would intuitively expect risk assets and the stock market to correct lower. So it's a bit of a feedback loop that has frankly forced the Fed to stop hiking. One other aspect of what we're seeing play out in the equity market at this moment is we have a lot of optimism. A lot of optimism based on the fact that the Fed is going to continue providing relatively inexpensive money. Like I said, not going to get back to 4 or 5% in Fed funds. However, they have also signaled that they're going to unwind the Fed's balance sheet. They're going to stop unwinding the Fed's balance sheet, and that is an additional stimulus that the equity market has already priced in. So if they don't follow through with that suggestion, then I would expect risk assets to be under pressure, and another aspect of the market, another experience with which the market will force the Fed's hand to be easier.
Okay, for the viewers, let me explain about the FOMC meeting and their dot plot. Yeah, every quarterly they show their projection for GDP growth and CPI, and also their forecast for the Fed fund rate. And according to their dot point, they expect or they judge the neutral rate is around 3%. So still 50 basis points is lower than the normal rate or neutral rate. So if I were Fed members for the next recession, I like to push the current Fed fund rate to the neutral rate. So is it possible for them to do it like me?
Well, the thing about the Fed funds rate and the Fed's projection is they've actually been wrong for a very long time.
Yes.
When the Fed started projecting its long-term Fed funds rate, it was initially at 4.3, 4.5%. It's now been revised down to the most recent estimate, which is about 2.8. And so what I would say is those last two rate hikes are much less important to the Fed than actually making sure that they don't derail the economy and that they don't derail the equity market. What I would also say is there's a bit of nuance. The Fed is far less concerned about the nominal policy rate. They really care about the real policy rate. And so in real terms, most estimates for normal are somewhere between 70 and 90 basis points. Currently, we're at 75 basis points, give or take. But what is important in that calculation is what inflation does. Because if inflation continues to underperform, then real rates are going to be tighter by definition. And so the economy will be effectively tightening for the Fed at a moment when the Fed is supposed to be on hold. I think that the track record of inflation underperforming the Fed's estimates is a very good guide. And so while the Fed has two more dots in their dot plot for this year, that assumes that inflation continues to rise higher. So if in fact we see a repeat of recent years where inflation is relatively benign, that will change the Fed's course.
Please short answers for this only question. So in your mind, how high is the neutral rate?
I think that good question. The neutral rate, we will know it once we've passed it, and we might be there right now.
Yes.
I would actually say somewhere between 2 and 2.5, given the amount of inflation that we have in the system, would be close enough to that.
Let's move to the U.S. economic condition. Nowadays we are seeing the slowing sign in U.S. economy. Last week the manufacturer index has deteriorated, but still the job market is very strong. So how can we understand the concrete signs about the U.S. economy?
Well, generally speaking, the labor market is a lagging indicator. It doesn't read what's going on in the real economy. So what I tend to look at is I tend to look at sentiment indicators. As you pointed out, what's going on in the manufacturing sector has been troubling. What we have seen is, due in large part to Trump's trade war, all of the optimism on the corporate and consumer side that was priced in during 2017 and 2018 has all now been completely priced out. That becomes very problematic because once consumers lose confidence, they tend to spend less. And if consumers are spending less this far into the cycle with the Fed hiking rates and providing a fair amount of financial system tightening, I would suspect that the bigger trend that will develop over this pivot or this turn in economic data will be toward lower growth estimates. And there is a risk that within the next 12 months, the U.S. economy is facing a mild recession.
Okay, so you mean just labor market is a kind of the lagging indicator?
And we have one last thing that I would add. There's a very strong history terms of watching for the turn in the labor market. What we have found is that since the mid-40s, every time the unemployment rate, the 3-month moving average of the unemployment rate increases more than 0.3%, the U.S. is actively in or entering a recession. And we're not there yet, but the unemployment rate is creeping a bit higher.
For the economic situation going forward. So looking at the yield curve, before early this year, I mean, the Jerome Powell has changed his merger stance. Actually, the yield curve has been flattening continuously. But I think after Powell changes monetary policy, the trend of yield curve flattening is over or is just slowing. So that means current monetary policy is still accommodative for economic conditions.
Well, it's difficult to argue with the curve only at 15 basis points when it's typically at 250 basis points. That represents a major shift in whether or not the outright level of yield is accommodative or not. I would make note that there are some parts of the yield curve that are presently inverted. Most notably the 2 versus between then and at the end of 5 years, the market is comfortable pricing in the end of the tightening cycle, the beginning of the easing cycle. Interestingly, the Fed doesn't care so much about the 2s-10s curve. What the Fed really worries about is the 3-month bill versus 10s curve. And there's a very material match between the flattening of that portion of the curve and corporate profitability. And it's about 1.5 years. And so the flattening, as you pointed out, that has occurred and been rather dramatic over the last 18 months hasn't even started to hit corporate profits. It's going to start to hit corporate profits within the first half of 2019. So I would expect that will create a meaningful amount of downward pressure on risk assets.
But historically, before recession, yield curve changes to inverted. So when the yield curve invert going forward before recession?
I think that the highest probability for the yield curve to invert is going to be over the next 2 quarters, because what will happen is the pendulum of economic system has really swung rather negatively. We've also seen the Fed become far more dovish than they had been in 2018. So what I would expect is the Fed, we're already starting to see this, the Fed will walk back some of that dovishness. And when the Fed walks back that dovishness, we will see the probability of a rate hike in December get slowly priced into the market. And that will push up 2-year yields far more than it will 10-year yields, because the market knows the Fed at most has 2 more rate hikes in this cycle, and so the longer end of the curve will remain well anchored, and it's that dynamic that I expect will take that last few basis points out of its curve and give us 2 or slightly below 0. I would not expect a very deep inversion unless the Fed, for some reason, decides that it's going to be a lot more hawkish than the market is anticipating.
I like to talk about inflation as well. So nowadays the CPI growth begin to fall again, so less than 2% that the Fed target. And actually, the slow in inflation is attributable to the oil prices. But nowadays, oil prices increase again. So current strong oil prices could keep the inflation pressure going forward.
The headline CPI numbers and the news have historically been very volatile, and the vast majority of what builds headline inflation are energy costs, oil, and food. And for that reason, the Fed backs that out, and the Fed can look at core CPI, which excludes those more volatile factors. within core CPI, one of the biggest drivers over the course of the last 2 years has been housing prices. And given the fact that the Fed has hiked rates and we've started to see the turn in the cycle, the idea that there would be downward pressure based on lower housing prices on inflation, I think, is going to become very real and to be this year's story.
In terms of the job market and inflation rate, I think there are still debate about Phillips curve. Someone said Phillips curve is still working, but someone said it's not working anymore. Yeah, so what is your view about Phillips curve?
I think that the Phillips curve does exist. I think that it conceptually is still working. I think that what has surprised the market is that in the current environment, the relatively reasonable amount of wage inflation that we have seen hasn't been enough to really move the needle for more inflation. That surprised a lot of people. Again, that doesn't mean that lower inflation, that doesn't mean that lower unemployment won't lead to higher inflation. But what might have happened if we hadn't had the strong labor market that we've had, we might have been in a situation where inflation was even lower than it currently is.
Let's move on your private life. Actually, Ian, I know you are the best analyst, the number one analyst in the US strategy sector.
So they say.
Yeah. So I think you look very energetic. So what makes you so that energetic?
That's a good question. I fear that I look more energetic than I actually feel. I do try my best to make sure to eat well and exercise. I've gotten a little bit out of the habit of doing running outside, but I do make sure to incorporate running into my regime. I don't sleep as much as I should, but I sleep as much as I can. And of course, one of the biggest things that keeps me going is I'm fortunate enough to travel a fair amount and I meet intelligent clients such as yourself, and it gives me a better understanding of the market and also it makes it exciting still, even after all these years.
Do you have any hobbies?
I would say that running used to be one of my primary hobbies. I have, like I said, scaled back on that. So just generally, I don't think it would surprise you to learn that I spend a fair amount of time watching the market, trying to connect with coworkers and friends to figure out how the rest of the world is viewing what's going on. And so in and of itself, that's kind of a hobby.
Okay. Actually, you visited Korea last week, so I know you visited Korea several times. So, what food do you like more? Which Korean food do you like?
Well, I obviously love anything with kimchi.
Kimchi, wow.
This last trip was the first time I've actually had cold noodles with the ice on it. That was actually a very good dish. The barbecue, obviously good solid meat barbecue is always a winner for me as well. I have to say that in New York, we live close to the Koreatown area, and we actually do, my wife and I, go and have food there quite often. I would say that definitely food is one of the most memorable aspects of my travel, particularly in Korea.
I really want to talk with you more, but actually you have a next schedule. Yes, Ian, I'm very appreciate you.
Of course. Thank you very much. Thanks for having me on your show.
Yeah. Lastly, please say goodbye to your fans, including me, because there are so many big fans for you. Yeah, you. So
well, thank you very much, and I hope that this episode you found very useful. Thank you.
Okay. Please follow me. Say. Okay. Just English.
I'm just not very good with language. Yeah, okay. I'll try.
Okay. 감사합니다. Do you know? 감사합니다 means thank you.
감사합니다.
감사합니다.
Yeah.
Okay. Are you ready?
Yes.
Okay. Let me give you a sign.
Okay.
여러분, 자, 지금까지 우리 정말 제가 존경하는 정말 제가 보고 싶었던 이안린젠 전략가와 길게 인터뷰를 해봤고요. 이제 마지막으로 인사드리겠습니다. 자, 여러분 감사합니다. 바이. 오케이, I hope.